What I learned from Peter Lynch's One Up on Wall Street: How to Use What You Already Know to Make Money in the Market book. This is Peter Lynch's acclaimed New York Times bestseller with more than 1 million copies sold. In this book, Peter Lynch explains how individual investors can learn about potentially successful companies long before the Wall Street analysts do, which can lead to picking 10 baggers, stocks that appreciate in price 10 times or more, allowing you to make 10 times your money invested. Peter Lynch's father died when he was 10, so he started working early as a golf caddy when he was very young and heard lots of stories from clients in the golf courses and learned from their stories as they talked about their investments. He then started his career in 1969 as a research analyst. In May 1977, he took over Fidelity Magellan Fund. At the time, it had $20 million in assets and 40 stocks in the portfolio. His boss asked him to reduce the amount of stocks to only 25, but Peter Lynch politely increased them to 60 and then 100 in 6 months, and soon after to about 150 stocks, as they were great bargains to be found and invested in. In his book, Peter Lynch shares the secret of his success as a professional stock market investor. In this video, I'm going to share with you the key lessons and information that have resonated with me the most as I reviewed the One Up on Wall Street book. For the remainder of this video, I'll narrate these lessons as if they are presented by the legendary Peter Lynch to all of us as small investors. Before we get into this video, I have a favor to ask. I've put a lot of time and effort to prepare this video, and I really appreciate if you can give this video a thumbs up. Thank you. Alright, rule number 1, stop listening to professionals. Any ordinary person using the customary 3% of brain power can pick stocks as well, if not better than the average Wall Street expert. In fact, amateur investors have many built-in advantages, such as their practical exposure to products and services, and observing firsthand how certain businesses are doing in their daily interactions. So avoid listening to experts, stock recommendations, or hot stock picks. After finding companies that you're intrigued with, it is time to do research. Remember, it is not hard to outsmart the smart money, aka Wall Street. Stock picking cannot be quantified, otherwise it would have been programmed in computers. There are too many obstacles for professional investors that prevents them to invest in 10 bagger stocks early on. If a stock is down and fundamentals of the company is good, it is good to hold on to your shares. And it is even best to buy more shares of that company. Very rarely, professionals have the gut to invest in unknown companies. Why? Because there's an unwritten rule in Wall Street that says a professional financial advisor for people will never lose their job losing clients' money if they invest their money in a known company such as IBM. Stock market is not a pure science. The greatest advantage to invest in stocks is the incredible reward you can get for being right. If you invested $1,000 and you were wrong, the maximum amount you could lose is $1,000. But if you are right, you can make $10,000, $20,000, or $30,000 over a long period of time. Clearly, stock market can be a gamble worth taking as long as you know how to play the game. Passing the mirror test. Look in the mirror and ask yourself 3 questions before you buy shares of anything. Do you own a house? Do you need the money? Do you have the personal qualities that will bring you success in the stock market? You should consider buying a house before investing any money in the stock market. It is a good investment for anyone. It is a money maker 99 out of 100 times. Like stocks, houses are likely to be profitable when held for a long period of time. Review your budget before buying stocks, and whether you need money for short term. Only invest what you can afford to lose without that loss having any effect on your daily life in the foreseeable future. Personal qualities necessary for success in the stock market include patience, self-reliance, common sense, open-mindedness, detachment, persistence, humility, flexibility, willingness to do independent research, equal willingness to admit to mistakes, ability to ignore general panic, and ability to resist human nature and your gut feelings. We don't believe in predicting markets. We believe in buying great companies, especially the undervalued or underappreciated companies. We have made money in lousy markets and lost money in great markets. It doesn't matter where the Dow Jones is at. Pick the right stock and the market will take care of it itself. Look for opportunities that haven't been discovered or certified by Wall Street yet. You might be asking how to develop a story about a stock and pick winning stocks. The best place to look for a 10 bagger is close to home. The shopping mall or wherever you work is a good place to begin. The average person comes across 2 to 3 likely prospects each year. What effect does the success of a product have on bottom line of a company? Big companies don't have major stock price moves, while smaller companies tend to move considerably. Assess the size of a company and categorize it in one of these 6 groups. Number 1, slow grower. These are usually large, mature companies expected to grow slightly faster than the gross national product, GNP. Category number 2, stalwarts. Examples include Coca-Cola, Bristol-Myers, Colgate, Procter & Gamble. These are multi-billion-dollar companies with faster growth than slow growers and expected to have 10 to 20% growth in annual earnings. They provide good protection during recession. Category number 3, fast growers. These are one of our favorite investments. Small, aggressive new enterprises growing at 20 to 25% a year. These could become 10 to 100 baggers, but they are high-risk investments, especially if they are under-financed companies. In this category, we look for ones with good balance sheet, making substantial profit. Category number 4, cyclical companies. These are companies whose sales and profits rise and fall with the changes in the economy. Examples include autos, airlines, tire companies, steel, and chemical companies. They flourish when coming out of a recession, but stock prices suffer heavily when heading into a recession. Category number 5, turnaround candidates. These are rebound companies which were no growers or maybe even bankrupt at one point. And lastly, category number 6, asset plays. These are companies sitting on something valuable that you know, but Wall Street has overlooked. The assets could be as simple as a pile of cash or real estate. Here are some key attributes you need to look for when searching potential investment options. A company with boring name, with a boring work, and something that is unpleasant. Also stock with little or no institutional investors. This would keep analysts and Wall Street away from it. If negative rumors surround the company, it can also create good potential. Another positive is if there is something disturbing about the company, as they keep analysts away while fundamentals are solid. An example includes waste management companies, which may not be treated as a pleasant choice. The spin-offs could also be good options, as in many cases they have strong balance sheets and are well prepared to succeed on their own. A solid company in a no-growth industry can also do well, as there will be less competition. Also, if the company has a niche, such as drug and chemical companies with a patent, they have an edge. Another required attribute is that people have to keep buying the product of the company. Moreover, we want the company to be user of a technology and benefiting from it. Also, if the company's insiders are buying the stock, it is a good sign, as insider buying can be a vote of confidence and suggest they believe themselves in the stock and the fact that it is undervalued. Lastly, company buying back its shares can also be a good sign. But what are the stocks that we will avoid? These include hottest stocks in the hottest industry, as hot stocks can go up fast, way beyond any known indicator of value, and as growth is supported by thin air, they can fall quickly. The stocks touted as the next big company, such as the next McDonald's, next Tesla, or next Disney, can fall into this category. Next of something is almost never is. The second category of stocks we avoid is whisper stocks. These are lousy propositions, more emotional choices. In other words, cases where there is a great story, but in reality, there is no substance to it. Lastly, the third category of stocks we will avoid are stocks from companies whose one customer account for 25 to 50% or even more of their revenue, and the loss of one customer would be catastrophic to that business. Remember to analyze stocks based on earnings and assets. Price to earnings ratio, PE, is a useful tool to assess if a stock has a fair value. It indicates the number of years it will take the company to earn back the amount of initial investment, assuming the company's earnings stay constant. If you buy shares of a company with price to earnings ratio of 2, you'll get back your initial investment in 2 years. The price to earnings ratio tends to be low for slow growers and high for fast growers. There you have it, folks. Hope you found this review and summary of the One Up on Wall Street book by Peter Lynch beneficial. If you learned something of value from this video and found it beneficial, please give it a thumbs up by liking the video. Let me know in the comment section, what stocks do you have on your watch or buy list at this time? Would love to hear from you. Also, don't forget to subscribe to Momentum channel for more videos related to investing and financial freedom. Thank you, and we hope to see you next time.